Fear.
Bitcoin breaking below 63,000 earlier today, on pace for its worst monthly decline since the depths of the last crypto winter 4 years ago. And it's tracking toward a fifth straight monthly loss, its longest losing streak since 2018. Now, we're looking at several forces converging here. Spot Bitcoin ETFs collectively losing around $4 billion over 5 straight weeks of outflows, its worst run since last February. You've got BlackRock's IBIT alone accounting for more than half the redemptions.
Fear. It's the only thing standing between you and the rest of your life. Right now, Bitcoin sits near $60,000 and the noise is screaming at you, sell, it's over. You've heard this before. 2018, they said it was dead. 2019, they said it was over. 2020, they said Bitcoin will never come back again. And every single time, the ones who stayed scared stayed exactly where they were, while the ones who moved when it hurt the most, they're the ones telling their stories now. This is not a dip, this is opportunity. It's a door. It's closing slowly enough that you can still walk through it, but it will not stay open forever. Because while everyone else is frozen, watching the charts, waiting for permission, there's people doing something different. They're not just buying Bitcoin, they're putting it to work, earning yield on it, letting their Bitcoin generate income while they sleep, while they work, while they live their lives, not gambling, not trading, a system that turns fear into leverage and leverage into freedom. The truth is, the fear you feel right now, it's not a warning sign, it's a signal. It's the market telling you that the opportunity is still here, it's still available, and it's still yours if you're willing to move while everyone else stands still. So the question is now the right time? The question is, how long are you going to let fear make your decisions for you?
Hopefully you guys enjoyed that intro. A little different than the usual. Usually I keep it raw, keep it 100, just go live at the camera. But I thought it was really important to capture a lot of attention, to get a lot of people that maybe aren't able to normally sit through a full-length video, because it's so important right now in the market. It's so stressful because many people are making mistakes. Many people are doing the worst thing for their portfolios right now at the worst time. They're selling the bottom. And it's something to where, if the 4-year cycle holds true, within the next 6 months, we're going to be bottoming out. At least by January of 2027, it is the absolute bottom. You should not be panic selling your bags at the bottom. It's so important that you get set up and you get positioned correctly. If you haven't sold at any time between $125,000 of Bitcoin and now, you should not be selling your Bitcoin. You want to be lowering your averages and DCAing into the assets that you want to hold long term. And better yet, and more importantly, you learn DeFi and you learn to monetize the assets that you want to hold long term. You use your money to buy more Bitcoin, buy more of your favorite assets, and you use those assets to generate cash flow and income to buy you more of those assets for free at these low prices, whether it's 60K or we go down to 54K or we go down to, let's say, 45K. Listen, anyone that tells you they know the exact price Bitcoin is going to, they're lying to you. I think 54 is a solid bottom. I don't think we go to the 40s. Who knows? We may. I'm not a fortune teller. If I'm right, I'm right. If I'm wrong, I'm wrong. Same with anybody else. We don't 100% know. What I do know is that historically, the next 6 months, we're bottoming out. We may have already bottomed or really close to it. It's not worth getting cute with it and trying to arbitrage a 5 to 10% dip and get back into the perfect time, because the odds are that won't happen. But it's so important you guys hear me when I tell you that this is the time to be monetizing your assets. This is the time to be doing the trench work, digging down and planting strong roots in your crypto bags. Get your solid assets and start to monetize them and cash flow them. So what I think I'm gonna do with this video is I'm going to put the mastermind day 1 and day 2 at the end of this video. But it's so important that you guys actually pay attention and retain what I'm talking about. It's gonna be a lot of information. Get a notebook, get ready to write stuff down, and be ready to take action at the end of this video and open your first liquidity pools. Lend your first amount of Bitcoin, borrow some money against it, and start running liquidity pools. Maybe for your first position, you just throw straight into a liquidity pool. You watch the second part of the video, which will be the second part of our mastermind from Thailand, and you'll learn to, again, lend that Bitcoin, borrow a bit against it, and then run a liquidity pool with that. learn the systems, and start to scale in, because the next couple months of this year is your last chance to get in at the bottom, or you'll be foaming the top and you'll always be like, oh, I could have gotten it at 60, but now it's 80. I'm not going to do it. And it's the same story as old as time that happens every month, every year, every 4 freaking years. It's the same story. So it is so important, you guys, that you lock in. That you lock in and actually change your portfolio to change your life. Because this is the only way. HODLing, yes, it's super volatile. Of course, that is the price you pay for that volatility to the upside. But you want to start generating cash flow off of that Bitcoin. So while you're holding, while you're suffering through the volatility, you're actually making an income and can take advantage of it. Every dollar you're earning through DeFi now at these prices, it's worth 1, 2, 5x more in the future, depending on your assets. If you're earning more Bitcoin, it's easily a 2x from here. If you're earning more Solana and Sui, it's easily a 3 to 5x from here. Easy. It is easy money for the taking. This is where the money is made. Run in when everyone is fearful. And next time, we are at all-time greed, at new all-time highs. Take profit. The nice thing is your pools will do some of that for you, but you need to be taking profit at the absolute highs, and this is the time. Again, so many investors, even some of our 10K fast track guys, they are feeling the emotions. They're talking about, if we go below 60, I'm selling. What are you selling at 60? First off, there's nothing left. There's nothing left of those bags. I saw what they were at 125, but really, why are you selling at 60? That is when you start buying. If we go below 60, that is fantastic opportunity to get started and get more Bitcoin and get more of the crypto you guys love each and every day. Please do not be retail. Do not be retail. Do not fund the bottom. Do not fumble your future in the opportunity that is literally right in front of us and so easy for the taking. Ignore your emotions, systems over feelings. Start your DCAs. If you want to, take the amount of money you want to invest, divide it over the next 6 months, and start getting in, because that is our timeline to get in the game if you are not all in already. And again, learn to monetize. I'm going to go ahead and put the mastermind videos after this, so stay tuned. Again, grab a notebook, get a Ravi wallet downloaded, grab a notebook, be ready to go, take some notes, and be prepared to take action at the end of this video. This is, again, content from our mastermind that I held and taught in Thailand this past February, which was the most amazing experience and everything I could have imagined and dreamed of. It was a fantastic experience full of guys that wanted to monetize their portfolio and grow their portfolio and taste that freedom overseas and just see what living off of your portfolio could be like. It was a beautiful experience. We do have a mastermind coming up in August. If you guys do want to attend, that is going to be in Spain. You can click the link down below, book a call with my team, get inside the 10K fast track. Of course, we definitely want our fast track guys to be the ones going, but we would love to have you at the mastermind where I can teach you and look at your portfolio in person and show you how we can best monetize your portfolio to be giving you a 5 to 10% a month return off of your portfolio to compound back into the portfolio at these low prices where everything is so much more impactful to your future right now. I can't stress that enough, that every dollar is so much more important right now at the lows. This is your opportunity. I made videos last year in April when we got nuked down to these prices where you literally are getting a shot at time travel to go back in time and see where Bitcoin and these assets can go. Again, you have a second chance to get in. This is your third chance to get in the market at these attractive low prices, and you will thank me later and learn to monetize them. It's what I'm all about on this channel. It's what I want to help you guys do each and every day. Click the link down below, work one-on-one with me, and if not, stay tuned to this video. Guys, it is like my last full day in Bangkok here. Came up to the rooftop on this skyscraper. Guys, look at the freaking skyline. It's just so different from anywhere back home, at least for me. Even downtown back home, we have a couple big buildings, you know, some big buildings, but there's just so many as far as you can freaking see out here. It's so crazy, but getting a little tan this morning, some morning sun. It's actually about like 11 something, so not a late morning, but get some late morning sun. I wanted to share with you guys the mastermind. I wanted to share the days of our mastermind because it's so important that you guys get in and get started printing, especially when values are down to where they are now. It is so valuable to get started now versus at all-time high when things are safe, when you feel safe to get started. You need to be getting started when things are boring,
when things are scary. And so there was lots of value given at this mastermind. Day one, which I'm going to share with you guys here in this video, day one is all about creating the actual systems that will make you money every single day to get cash flow in, because cash flow in is what gives you the life that you want. It's what allows you to just be staying here in Bangkok, doing Lord knows whatever it is you want to do. It allows you to travel wherever you want to be. It allows you to work the job that you want to work. It allows you to be who you want to be. And that's going to be cash flow. Cash flow equals freedom. Cash flow is what actually gives you the freedom. Buying a bunch of Bitcoin, it's really cool, long-term, great play. Obviously, I believe in this as well. Obviously, I want to hold as much Bitcoin as possible. But it's not going to give you the freedom now that you're looking for. Learning how to monetize that Bitcoin to get cash flow in every day, cash flow online. It's better than even an online remote job because it's from anywhere in the world, any country in the world, all the time, 24/7, permissionless, cash flow every single day. And that is what will actually give you the freedom that you're looking for, not just buying Bitcoin. If you hold your Bitcoin for 10 years, yes, that is going to perform very well. It'll set you financially free, I believe. It's going to make you lots and lots of money. But cash flow is what will give you the freedom you're looking for today. And so it's very important you guys pay attention to this video. I would recommend definitely putting out a notebook, taking some notes. I'm gonna put some of the PowerPoint slides on screen so you can pause the video when they come up and then you can write those down, take a screenshot if you want, that's fine. The information is always free, but it's very important that you guys pay attention. People paid thousands of dollars to attend this event to learn the lessons that you're gonna learn here today. So it's very important that you take this information and not just learn it, not just write it down and take notes, but actually take action. Take action day one, take action today as you watch this video and you start to learn the concepts of DeFi, what it actually is, start to understand it. You can then actually get started. Open your first pool. Make sure you have Rabby Wallet downloaded, okay? Download Rabby Wallet as you're watching this video as well. Get your seed phrase set up on a brand new wallet and then send some Ethereum over. Open your first liquidity pool through VFAT with Rabby Wallet. Just get your first one going, because if you can do anything in DeFi with $10. Guys, you can borrow that from your freaking kids if you have kids. I mean, $10. Everyone has $10 and you can start your first pool with literally $1 if you wanted to. Again, you could just borrow that money from your freaking kids. It's not exactly hard to obtain. If you don't have $10, you're probably watching the wrong video to begin with. But open your first pool today if you haven't already. And then if you can get the systems going to learn how to create cash flow, to understand what's going on in your liquidity pools, all you have to do from there is just scale. Just scale your portfolio to get you to the income level that you want. If you need to make 10K a month to be free, you just got to scale to where you're making 10K a month. Scale your assets that are being supplied. If you only need 5K a month, even easier, 3K a month. If $1,000 a month would change your life and you could live digitally out here in freaking Bangkok or Koh Samui. We left Ryan out there. Ryan decided to stay. He's just going to live out there. That's the freedom that you have when you have liquidity pools, the freedom to choose the life that you want. So guys, again, just please pay attention to this video. Take notes, get a notebook out, screenshot the slides if you want, take the information, but it's so important that you implement it. And guys, as you watch this video, if you do have some crazy questions coming up, just drop them in the comments, or of course, book a free call down below. Book a call with me where we can work one-on-one and get you set up to cash flowing as soon as possible. Guys, just pay attention, and I'll see you at the end.
Thank you for being here. Koh Samui, it's beautiful. Hopefully everyone slept. Great. So here's my objectives for you guys. A 3-day overview. Hopefully you can see, the glare is crazy. But my objective for you before you leave, to build a self-sustaining system, that you guys actually leave with a system that's going to compound itself over time and be buying you assets back, and more importantly, just buy your time back, buy your freedom back, to where if you didn't want to leave, you guys could hopefully just stay here forever. That's the goal. Or come back and make a life out here. I'm going to treat you, especially tomorrow, how to leverage your equity. So actually treating Bitcoin as property. Leverage your equity inside Bitcoin, other blue chips as well, to build your cash flowing crypto business and create this infinite flywheel where it's going to become an income that perpetually just grows your portfolio over time. And it's going to give you the life you desire. So today we're going to focus on DeFi as a business, operating your liquidity pools as cash flow positions, because we need to get the income in. We have to master those fundamentals. Tomorrow, again, we'll focus on the actual flywheel, how to make the game infinite to where it feeds itself over time. And then day 3 is going to be how to scale and how we can survive bear markets and anything the market does throw at us. So, okay, DeFi, running it like a business. Some of you guys have heard this before, so little repeats here, but it's a service-based business. So it's not a fugazi, it's not a fugazi, it's not just free money you're making. You're actually providing a service. You're providing swaps for investors and traders, and you are providing the actual assets that they're swapping between. It is a real business. It's the mom and pop exchange. It's small business version of Coinbase, Kraken, Gemini, big names in the space, Binance. It's the mom and pop version. And our competitive edge is we have the lowest rates. We're fast, we're permissionless, we're not holding your passport for 3 days, waiting for you to get verified or anything like that, and we're serving blue chips. To really keep that edge, we want to make sure we are in blue chip assets that will always have that demand. And our focus, again, is going to depend on asset quality, TVL we're going to go over, setting ranges, managing impermanent loss, etc. And we're just trying to take you from being someone that's just been hodling your crypto, hoping something happens, hoping you make money, and actually start making money on day one as a business operator. So I told you guys I was going to do a lot of comparisons to the real estate world, property versus Bitcoin, showing that you own your Bitcoin and how we can monetize it. In the real estate world, you own your title, you own your home. A lot of you mentioned you guys own your home. And then there's potential to cash out refinance where you can pull equity out of your home. That's something we can do in crypto as well. Your collateral usually being the house itself. Bitcoin has the same opportunities. You own your Bitcoin, you own your keys, you own your coins. Story as old as time. DeFi borrowing instantly without credit checks, without anything like that. We can be pulling equity from our Bitcoin, which we will go over heavily tomorrow. And digital collateral. Your Bitcoin is the collateral. This can all be done from a laptop, from your phone, in Koh Samui, Bangkok, US, UK, Australia, wherever you may be from. India.
Not India.
And key insight there as well, we're going to be using equity from quality assets to fund the actual cash flow business. So the usual model, I've taken a lot of principles from the real estate world, from successful real estate investors that have been in the game for years and years and years, and from private equity as well, and I've applied it to crypto. And this is how I actually run my portfolio. Owning your home is easy. A lot of people would say that if you're just owning the home, it's not really as much an asset as it could be a liability. Problems with the house, etc. But buying the house creates the asset. You hold the title, but it sits empty. You're making no cash flow. It's sometimes considered, I would say, a liability if you're just living in it. When you're taking it like Joe and you're renting it out, finding tenants, this is the hard part. You're finding tenants, you have maintenance, management, but it's what transforms it into an actual business.
And a leaky roof.
And a leaky roof, exactly. But this is how you actually, this is the hard part. You're renting it out, it's the hard part. Managing the home is the hard part, but it's what gives you cash flow. And that's why today we'll be focusing on the hard part of DeFi as well. But ownership, you own the Bitcoin. You self-custody your assets. It sits in your wallet. It has the potential to appreciate, but a lot of people that are just hodling, they need it to appreciate. And that's where we're changing the game. Set ranges, running liquidity pools, running the exchange that allows others to trade. And that's what actually builds our income, is facilitating trades. We're monetizing volatility. We're monetizing greed, monetizing fear, monetizing the market going sideways, making money every day. This is the hard part. Owning the Bitcoin's easy. You just buy it. This is what we're focusing on today. So again, for some of you, this may be a bit of a refresher, but what is a liquidity pool? It's your own mom and pop exchange. It's permissionless, it's fast, it's instantaneous. People are saving money. They're spending only a couple bucks, couple cents, versus hundreds of dollars on Coinbase. A 10 grand transaction on Coinbase, I've seen quoted with a $250 fee plus. The same 10 grand swap through DeFi can be $1, $2, maybe $3 max. It saves people a lot of money. You are stocking the shelves with two currencies. That might be Bitcoin and USDC, Ethereum and USDC. And when customers trade that specific pair, the fees that they pay are going directly to you. It's 24/7. You have no employees, no overhead. You just have to have the inventory to actually offer. And again, we're cheaper, faster, permissionless. And again, we're saving people money. It's a real business, and you can feel good about it because we're saving people money, giving them instant access to liquidity, and we are making money the same. You provide liquidity into the pool. When traders are swapping, whether they're bullish, whether they're short-term traders, whatever they may be doing, selling their bags, they're swapping our assets. They're giving some USDC, they're taking Bitcoin, they're giving Bitcoin, taking USDC, and all the fees they pay just go back to us. It's a business. So getting started, the most important thing will be the quality of your assets. Hopefully this is known already, even if you're just a hodler right now, because you're a retail store. You're selling two specific currencies. If you have a store that is selling goods and those goods go to zero, if you're selling just Pokemon cards and the craze just dies down, you now have little $4 packets that are no longer $400. You don't want to be buying assets that are going to go to zero. Unlike a bank, your capital is exposed. You actually hold those assets. That is your net worth in there. You do not want that to go to zero. If your product goes to $0 in value, so does your inventory of that product. And in a liquidity pool, because you're swapping between the two assets, so you have Bitcoin and something else that's trashy in there, if that trashy coin goes to zero, you slowly go to zero as well. Blue chip focus, only open liquidity pools with assets you truly believe in and that have a long-term future. If you hold something and you believe in it long-term, you're gonna have conviction. It's gonna take emotions out of the game. And if it does perform like trash or go to zero, you already held it anyways, so your downside risk has not changed. But don't build your house upon the sand. Risk should be a very small percentage of your portfolio, maybe 5-10% max. Yield chasing will always end in destruction, and it's always the last thing on my checklist. I'm looking for assets first, ranges second, APR is the last thing that qualifies my position. Not sure how religious everyone is here, but this little quote from the Bible verse here, but everyone who hears these words of mine and does them will be like a wise man who builds his house on the rock. The rain fell, the floods came, the winds blew, beat on the house, but it did not fall. We want our portfolio to be the same way. A concrete foundation, the rock, Bitcoin, Ethereum. Don't build your future on microcaps, on meme coins, things like that, because there's no proof they will stay here forever. And again, don't chase yield. It will lead you to zero, black hole. TVL. So when we're looking for metrics, the first is asset quality. We want to make sure we have good assets. Second is the TVL. And for some of you, you guys will kind of know this game. Joe, I know this is new for you. TVL is essentially going to be both a proof of concept and also your competition. It's going to show that the more TVLs, the money locked in a pool, okay? So the more money there, it's showing you that it's profitable, people like it, it's safe. If there's a lot of money congregating there, it's because it's successful. You know, just like you think a stock. The larger cap the stock, the more people like it, the better it's performing. But it's also your competition, because it's the amount of people doing exactly what you're doing. So the fees, the actual money that that pool generates, gets divided amongst everyone that is providing the TVL. So what we're really looking for is a competitive edge, a high potential edge. The lower TVL you go, it shows that you have to kind of watch the warning signs. Like, why is it so low? Is it risky? Am I in a new location, a new blockchain? Is it a bad token? Which we shouldn't be if we're following step number one. But we're trying to find the edge between where we can have a proof of concept to where we have a good TVL, but we also can be a big chunk of the pie because we want to get a big cut of those rewards. When you're starting out, $100,000 minimum TVL is a great baseline to start, just to make sure you are not somewhere you are not supposed to be. We don't want you to be somewhere you don't belong and lose money. Making sense so far? Sweet. Volume. This one is the exciting one. This is how you actually get paid. It's the foot traffic. It represents the literal customers walking into your shop. Without traffic, even a high TVL pool is going to make no money. Even a low TVL pool is going to make no money. We have the input, volume, the fee tier, how much we're paying, which we'll show you in the live example kind of how that works. And the output is how much money you're actually making. We want high foot traffic on evergreen assets. We want to run a business forever. High volume on meme coins, you're gambling. You can make a lot of money, but again, your inventory can go to zero. We're trying to find assets we want to hold for the long term, and there's more than these as well, which we'll go over, but like ETH, Bitcoin, sustainable long-term assets you can hold throughout volatility, and a sustainable business long-term. And again, I covered in the last slide, but our secret edge here is going to be finding that peak area where we're getting high volume, but a more lower to mid TVL, not super low, but we're trying to find a competitive edge to where we can make as most money possible on the safest assets possible. It's like an ATM. It literally is. So it's like you're trading two currencies. Someone's coming in, they're swapping their Bitcoin for cash. They're swapping their cash for Bitcoin. It's like when you get off the plane here in Thailand. You want to make sure you're going to the ATM. But keep in mind foot traffic. At the airport, finding the best location. At the airport, lots of people are flying in, trading all their currencies for Thai bahts. You want to make sure that there is actually demand for those assets. You're picking the good assets. But TVL will be like your competition. If you're going off the airport and there's 10 different exchange counters, they're obviously going to be splitting that business. You're splitting it with more people. So you really want to try to find a place where it's high foot traffic, but not as much competition. You want to find a place like, and there has to be demand for the asset too. So you can't have a Thai baht counter back in the US because there's not really a lot of people coming from Thailand looking to trade their currency. It's just not the same game. If you have a Thai baht ATM, you really want to make sure it is in Thailand. And again, you want to make sure there is high demand outside Nana Plaza maybe, or outside the airport, somewhere where people are actually going to need cash. There needs to be actual demand. And again, this is how we're going to make money. Making sense? Good? Good so far? So setting ranges for long-term success. When I first got started, I was going way too tight oftentimes, and that usually led to mistakes and then doing the worst thing at the worst time. What I have learned over the last probably about 3 years now in DeFi is that you need to zoom out. No 5-minute charts, no hourly charts. I'm literally looking, usually the closest time frame would be the 4-hour now, if not the daily, and if possible, the weekly. I'm going wide. I'm setting things up to where it affects me 0% emotionally when prices are swinging, and I'm making money every single day. I tell people oftentimes, like our new member onboarding calls and stuff lately, if you were to get deployed in the military overseas for a year, would you be comfortable with the assets you hold and the ranges you have set? If not, you are probably in something that is either too risky of a coin or too tight of a range. If you're worried about going on vacation, you leave your laptop at home and you come back and your portfolio is going to be gone, you are completely playing this the wrong way. I literally can go a whole month and not check my stuff, and I check it, claim my money, and then that's that. It removes emotions. Because we're literally not trading. We're not taking bets. We're not gambling. We're trying to earn as much money as possible for the long term. All right, it's going to get a little heavier now. A little heavier. Inside the pool. So what actually happens? How does the composition of your pool change? So if, again, some of you, a little bit of a refresher here. Joe, buckle up. Here we go. Asset composition. You're literally a market maker. So you're taking your two assets. So it would make sense that if you're facilitating transactions, if the price is going up, that means there is high demand for an asset. And that means that tons of people are handing you cash. They're running at you with cash, and you are giving them your asset. So you start to get full of stablecoins. Does that make sense? Because they're giving you all your cash, and you're giving away your Bitcoin, you're giving away your Ethereum, etc. The opposite is true to the downside. When the market's nuking like it just has, and everyone's running for the hills, what they're actually doing is they're selling their Bitcoin to you. So they're selling their Bitcoin, they're running away, the price is going down, and so you start paying out people cash. So you start to become really heavy in the actual volatile asset. Bitcoin, Ethereum, Solana, whatever pool you are actually running, you start to DCA into that asset because you're handing all your cash away and you're buying it from everyone. And then in the middle, it's kind of 50-50. As you hit that middle of your range, and there's, we're kind of in the middle of the market, in your middle of your range, you're holding a 50-50 of both assets because it's kind of in the middle there. People have sold their assets, some people are buying the asset, and you're at an even composition. You're just a store. You're running a shop. When price exits the top of your range, again, you've sold all of your volatile assets into stablecoins, usually at a take profit zone. If you've set wide ranges, like for me, I have some wide ranges on ETH at the top, Ethereum at like 4,500. At that point, I probably want to be taking profit anyways. It's already at a take profit zone, so I don't feel bad leaving with cash. If you go too tight, you're gonna get cashed out of the assets you want exposure to way too early. When price exits the bottom of your range, you have DCA'd in at a better price. You have bought the dip automatically, and if you, again, have set strong ranges, resistance levels, bottom of the market, you can just do nothing. Wait for it to mean revert, the market comes back into range.
Can you repeat the price exits top of range?
Yeah, of course.
So, price goes up, you just withdraw it?
That's definitely an option.
Back in?
Yep,
It's
definitely an option. So think, for example, Ethereum to 4,500. That's where my top is. When ETH goes back, my pool, because I've been holding a lot of the asset as well, also gets appreciation. So I make profit on the way up, plus my fees every single day. And at the point where I reach the top, I'm all cash. So I now can look for a new opportunity that has not pumped yet, rotate to something else, a different altcoin, a different coin. I could open a new range, but if I have set really strong ones, it's probably a good time just to walk away, take a break. And I can also then lend those stable coins, run stable coin pools, and try to make 10% a year that way, maybe plus. And keep making money, keep the money moving, buy gold, etc. So you have lots of options, but usually if you set a really strong range, I like to not chase that price action because as we've seen time and time again over the last 3 years, it comes back. It comes back every time. Impermanent loss. So essentially, This gets demonized quite a bit. It is a tricky subject to talk about. It's worth noting that tomorrow, the strategy I'm going to teach everyone that puts everything together, it completely avoids this problem, but it is something to be aware of. Basically, first off, it is temporary. But what impermanent loss really is it's the difference between if you were holding, let's just say Ethereum again by itself. Ethereum right now is 2K. At 4K, it's doubled in price. You take profit, you sell it, whatever. In a pool, because you're paired with another asset, let's say USDC, you wouldn't appreciate as much, but you are making daily fees. So a couple things. First off, impermanent loss to the downside. Impermanent loss is your friend to the downside. If the market moves down, you lose money slower than anyone holding spot assets, plus you are making fees every single day. So you actually lose money slower. When the bull run comes, you will make appreciation a little bit slower, but again, you're still making fees. The longer it takes the market to move up, the easier it is to maybe even beat the impermanent loss, if not break even with holding that spot asset itself. Now, again, it's temporary. A lot of people, I think maybe even a lot of people in this room, did we sell all of our bags at the all-time high?
Hell no.
No. So it's impermanent. So the thing is, your ETH doubled in value to 4K, and now it's right back here. So if you haven't taken any money, you've literally made $0 if you took no profit, whereas the pools were printing the whole time. Up, down, so you're now above where you started because you've been printing. Let's say you're printing 10% a month every month. The last 6 months, it's an extra 60% you've made. Whereas your Ethereum, you were holding spot, you thought you were gonna sell the top, no one ever did. You probably bought the top. Yeah, it's a different story. Hopefully that kind of makes sense. We'll again cover this more tomorrow as well with the flywheel strategy. But it just means you're selling your assets as they pump. So you're literally taking profit on the way up. So you're taking profit without having to actually manually go in there and do it, because as we know, a lot of us, traders especially, they get emotional and they're buying the tops and selling the bottoms. This actually has you doing the right things. You're buying the dips automatically and you're selling the tops automatically. And we're here for yield. If your pool's earning APR and you suffer a little bit of impermanent loss, usually that APR, especially if it takes long enough, you actually can out-earn the difference if you have wide ranges. So when to exit a liquidity pool? I like to think of it as a supercharged swing trade. So I'm setting wide ranges. Daily time frame, weekly time frame, highs and lows in the market. And the longer this trade takes to complete, the more money I make. If I'm making 10% per month, I'm building my bag at 10%, whether Ethereum is still sitting at $2,000 or it's already pumped to $4,000. The longer it takes, it's just a supercharged freaking swing that gets bigger the longer it takes. It's literally so perfect. When I finally complete the trade and it goes to the top of my range, you were kind of asking about this.
So you kind of set and forget
Yes,
for 1, 2, 3, 4 months.
longer. I've had pools open even longer than that before. As prices rise, the pool will automatically sell your assets into the stablecoin or the more blue chip asset, and you're taking profit the whole way up. So it's doing literally all the hard work for me. At the top, actually, let me go here real quick. The longer the pool runs, again, the more the fees are compounding. So the longer it takes, the more time, the more money. And you got to think as well, if you're earning 10% a month down here with Ethereum at $2,000, and you say you're just reinvesting that into Ethereum on the side, that 10% a month you're making, when Ethereum goes back to 4K, in hindsight, that was more like you were making 20% a month, because every $1,000 you're reinvesting at 2K is now $2,000. So the longer it takes, the longer you get the shitty market at the bottom, the more powerful this really is, and the more it exponentially can grow your portfolio. Now, as price drops, you accumulate more of the assets. That's literally what I just said, JK. Exit criteria. So the only time I close the pool early is if I don't believe in it. Black hole. Lost conviction in that completely. I lost belief. Think it's a trash, more like a meme coin now. It didn't do what it was promised. Alex Becker, big names behind the coin. I no longer believe in it. I think it's just, it was a promo. They made a lot of money off of it, and a lot of people lost money. I dumped that coin. Dead project to me. Still use the ecosystem, but I don't hold the coin. Market structure broken. Do you think we're going to zero? Well, you shouldn't have the pool open because you're taking inventory of assets. If you truly believe we're going to zero, like Bitcoin, quantum computing's coming, and like it's game over, you probably shouldn't have your pools open. Price at a range to the upside. This is a good problem. You finally taken profit. Jake, he hasn't, on YouTube, he hasn't taken profit. People make fun of him all the time in the comments, and it's like, he finally did. He finally took profit on something. You've successfully exited your swing trade, and you can redeploy somewhere else that hasn't pumped, or you can take your profit and go spend it on something, actually enjoy a trip, take a vacation, buy something you need to buy, lend it out, make 10% a year, which we'll cover again tomorrow as well. And if you've got a range to the downside, We have more options we can talk about tomorrow. But you don't panic. You're just holding, let's say, Ethereum. You've DCA'd into Ethereum at the best price possible, and now you're holding. It's the same risk that literally everyone sitting here has now. Are you holding Ethereum? Same risk you have now. Except you actually lost less money and you made fees the whole way down. If I do go out of range and I'm thinking about changing my range, I always wait at least 48 hours, or you can then open a short to try to hedge your downside, which we'll talk about day 3, actually. And we have VFAT time. So basically, once Jake gets back in here, we're going to do Q&A. We're going to do a live example of everything here, like actually get some pools open. Anybody have any questions off the top real quick? Just like burning stuff, if you wrote anything down. It's kind of just a general overview of the process. And then we'll just... VFAT. Yeah. It's just one of our favorite tools to use to open liquidity pools.
Like what happens if you set the ranges and the price goes beyond the range?
Up or down? Up?
Up, yeah.
Cashed out.
You just automatically sell.
Which we're going to show a live example, but yeah, it sells you slowly the way up. So it's actually like there's a curve the whole way up, and you're slowly selling on the way up.
It's that range, you just don't have anything in the point, right?
Cash.
You just have.
And once it leaves, you no longer make money, but you're just holding cash.
Is that into the you like stable coins? You sell into.
Yep. Oh, it depends on the pool. There are asset to asset. So you might, let's say you have ETH and Bitcoin together, and ETH's pumping, it starts to sell you into Bitcoin, and then at the top, you're just holding Bitcoin. So we'll show some examples here together in a second.
But this is why you only want to do it coins you like. At the end.
And it's why you don't want to go too tight. If you go too tight and you get cashed out way too early, now you're stuck facing like, okay, fuck, do I have to buy Ethereum at 3K now and I already had it at 2K? So you want to make sure you spread it out.
But I know, like talking about Ethereum, say, what is it right now, at 2 or whatever? It goes to 3, and you know it's going to go up. You would still cash out and buy back in?
I would
rebalance it?
I would set my range higher to begin with.
Okay.
And I would do it sooner than later. Yeah.
When you've set it, can you change the range?
Yep. But you need to keep in mind what's going on, right? So, which we'll be able to show you better when we screen share. But say I have a pool now, and I'm about 75% in cash, and I do change my range, I'm going to be taking some of that cash still and be buying more Ethereum at the current price because I'm changing my composite. It's a little complicated. It'll be easier.
Yeah, so you're better off just sticking to what you do.
So I really try to do everything right the first time. Because later on when you make change, especially right now, everything's such a good value zone. Later on, if you're making changes, if you have to rebalance, you're usually doing the worst thing at the worst time. Because it's too high, and then you're changing, you're buying back in at a high price.
Have you seen, like if you're in a wide range where you're making less APR, how could I say it? Like if you're in a tighter range now and just rebalance later, wouldn't you be making more? You know what I mean?
The numbers don't work out because,
Okay.
so I'll tell you the problem. Let's see what the best slide is to show. I want to do it on this one probably. So it's like price goes up. Say you have like a 10% wide range. Like let's just say it's like $2,000 ETH to $2,200 ETH. You have basically no upside exposure because in that 10% band, you cash out the stable coins. You get pushed to stable coins right away. So you're not really going to get any upside, and you're really going to be hoping that it stays in that really tight range for you, which I've done these tight range, 12% wide ranges before. Yeah. It doesn't work out. Cash flow is really good. You'll be getting like 300, 400%, but it's not sustainable. And your downside is almost basically 100%. Because if the market goes below 2K, you just DCA to ETH, and you'll ride that down wherever it goes. And then when the market finally pumps, because crypto is volatile, and you make a lot of money at that upside, you're not going to get any of it because you're going to get cashed out ASAP. You're going to get like 3 or 4% max because you're going to get cashed into cash pretty quick.
So yes, tight ranges are for traders, wide ranges are for investors.
I would agree. So I mean, it's just a business where it's like you want to be making money every day, and over the long term, you're going to make a lot more money running a wide range than you ever will a tight range.
More like a steady, slow race, I guess, if you have the ranges wider.
Exactly. And then with tomorrow, we're putting some things together too it's just going to supercharge the portfolio a lot more. And then with a wide range as well, it'll give you the opportunity to, in the bear market, be able to short and try to hedge positions. Whereas if you're going tight, it's going to be almost impossible to manage because your composition will change too fast. So, yeah.
Can you leverage the liquidity
You actually can on some of them, but tomorrow we'll be showing more about leverage. Yeah. There's some that you can't though, actually. Yeah.
Why do some tokens have DeFi protocols versus like others that just don't exist?
Yeah, no, that's a good question. So a lot of my investing thesis changed as I started getting into DeFi. So I was in a lot of projects that just, they sounded cool. YouTubers tell you to buy them and things like that. As I started to actually get on chain, I figured out what assets actually have volume, what assets have demand, what assets actually have this whole on-chain ecosystem where you can send people money whenever you want, you can trade whenever you want, you can buy other coins, there's protocols, you can lend money, borrow money, swap, provide liquidity. So I've spent a lot of time in this space finding these actual protocols, and a lot of my portfolio has transformed to what actual blockchains support those activities. Hence why I don't have XRP.
Right, but why wouldn't it exist on like XRP or like BCH, for example?
Yeah, I mean, to be honest, why they don't have one, I'm not entirely sure. I mean, they haven't structured for that. No one's building these protocols on those ecosystems. And there's new coins that come out that have them, and there's some smaller ecosystems elsewhere, but there's some tools like DeFi Llama, which we can show as well, which will show you the actual, for example, I remember Celestia was a coin I bought. I don't know if anyone knows that coin. No? It was a new one that came out a couple years ago. I was getting started, and I think I've sold out of it, by the way, but last week they made $14 in revenue. So, and that's just showing you there's no actual activity there. People were kind of farming it for airdrops, and once the airdrops were over, it was GG. There's no actual community and ecosystem there. The things that are surviving the bear markets right now, where those chains are still making money, people are still lending money, borrowing, there's a whole ecosystem, that's where I want my money to be. And so that's why my portfolio has slimmed down significantly to what's actually profitable, making money. From a business mindset, especially.
Guys, hopefully there was insane value in there for you. Hopefully you took great notes and you can implement and open your first pool literally today. Get started today. If you want to work with me, you can book a free call down below. The Mastermind Day 2 I'll have up here. If you're watching this when this Day 1 first goes live, it's going to take a couple days for Day 2 to come out, but it will be right up here. And if not, it will be coming soon. So again, guys, book a free call with me down below. Let's get started as soon as possible, and I hope to see you on the other side. Once you get started cash flowing in your liquidity pools, the problem is that the game eventually ends. The game will eventually end when you get out of range. You have to decide, where does the money go now? And so at our mastermind, the Day 2 talk that I gave was all about the infinite game, how to make sure the game never ends, using your collateral and pulling equity from that to then run the pool. So the game never has to end for you. It becomes an infinite game where you just invent money, use that to cash flow, and buy more assets back to your treasury bags over time that'll help you win for sure and forever. You just keep winning and you keep compounding. And this is really the most important day of the whole mastermind here, was Day 2. And I'm gonna let you guys in on it. So I want you guys to be prepared. But it is the most important day for success. It is what makes the game truly infinite and gives you exponential returns that you won't get from just running liquidity pools. You won't get from just holding Bitcoin, Ethereum, or even altcoins, or even meme coins. You're not going to get these returns unless you put the Day 1 talk, which you can find on the channel, or in the Day 2 talk here. You put those two strategies together. You will not get results like this unless you're taking all the conversations and concepts from Day 1 and you're combining that with these here in Day 2. So it's so important, again, guys, you're taking good notes as you watch this video. Take good notes, write down questions you have and get those answered. Leave a comment with me, book a call down below. We'll get them answered for you. Book a free call, it's free. We'll see if you're a good fit for our 10K fast track. This is the best information. And it is just, I'm taking all the concepts from the real estate world, the private equity world, and applying that to DeFi. People, they've been running the same game with real estate for years and years and years. And it's just taking those strategies and applying them to crypto, that new frontier of digital finance, to give you insane success that no one else is having, because no one's taking the steps to learn how to do this. But when you do it, it just changes your portfolio and it makes it infinitely better. You get exponential returns, and it's the best thing that you can actually do for your portfolio, because liquidity pools by themselves, if we go sideways for a long time, they're fantastic. But when you do them against your collateral, when you do them off borrowed money, you're leveraging your assets to get into cash flowing businesses on the blockchain. It changes the fucking game. It changes the game, and it is 100% the thing that I think is best for your portfolio. It is the best way to play DeFi. It is the best way to play crypto right now, and it will make you rich and you will win for sure. But you need to get started. Take good notes, pay attention to everything inside this talk. Again, questions, drop them in the comments down below. Of course, book a call with me as well, and we will get you started to cash flowing the actual life of your dreams and get you set up with a system just like this, where you can run an infinite game, where the game never has to end. You're always cash flowing. You always still have collateral as well. You always have the assets, and you're just making more and more money every single day. And so I actually hopped off a call with my biggest client, Grant, the other night, right? And we were talking about how the market's down like 50%, but how he has so much more Bitcoin than he had before. And we were just kind of running some numbers, right? Where it's like the portfolio kind of peaked out at the high in October before 1010 at like 1.2 mil. Like it's pretty good, right? Like for most people, it's probably a goal is to hit 1.2 mil. And the market's moved down. Obviously, his portfolio value is worth even less right now, but just doing the math back to that all-time high, or really close, like at 120K, where BTC, his portfolio was worth about, again, 1.2 mil. It's like we did the math and he'd be at 1.7 now because he's building so many freaking assets for free. It's just exponentially just changing the game for him. So right now, if the market just boom, went back up to where it was in October, he has so much more assets. He has so many more Bitcoin. He has so much more Ethereum that his portfolio that was 1.2 in October would now be $1.7 million. And for him, that's just insane value, where he's actually seeing it in real time that he has so many more assets and the game is changing for him. He's like, wow, that's crazy, because it's easy to be sad that the market's down. It's easy to be like, we're just boring, it's sideways, yields are low. But it's absolutely just changing the game for him. And he literally has an extra $500,000 ready to freaking go just from freaking printing. So again, this is the most important strategy you can use, and it's working well for me. Jake's starting to run it as well. It's working fantastic for Grant. From 1.2 high to when we go back, he'll already be at 1.7 mil. Not to mention if we set new all-time highs, guys. But it's very important you pay attention, take notes, book a call with me down below. If you have any questions or you want to get started as soon as possible, book a call. For some people, it's just because it'll take all the mistakes away. If you want to get started as fast as possible, make no mistakes, lose no money, take action, book a call down below, and I'll see you on the other side.
Day 2. We made it through day 1. Day 2 is equity in the infinite game. How to keep your portfolio printing over the long term to build sustainable daily cash flow systems for the rest of time. Again, revisited, our 3-day objective is going to help you create a self-sustaining system that compounds over time and feeds you daily cash flow to buy back your freedom. This is one of the most important days for this flywheel. Asset sovereignty. Treat your Bitcoin actually like the personal property it is. We'll learn to leverage equity in our blue chips like Bitcoin, Ethereum, Solana, without selling them. The infinite flywheel, use business income to fuel an infinite loop. We're going to learn how to borrow against our property, deploy that money elsewhere to earn income each and every day. And then we're going to scale and automate your portfolio. This one's going to come tomorrow. So equity in the infinite game, what is this about? Some of you guys have heard me preach on this for a little bit, both on YouTube and inside the 10K Fast Track. But again, use the equity in your long-term assets to scale your business. We don't want to sell our golden goose, that Bitcoin. We don't want to sell the best asset that we own. We want to leverage against it to buy more of those golden eggs. This is the first step to the whole process. Yesterday was the hard part. So we went over, don't fucking fall asleep, I swear to God. I saw those eyes closed. This is the first and most important step to the whole thing. Yesterday, I would say, is the hardest thing to learn, so we touched on that first. This is the first step in the flywheel 9 times out of 10, and it's required to feed your income machine. But we have to be purposeful. It is easy. I would say this is one of the easier lessons. But without a proper understanding of our debt and risk, we endanger the entire loop. We can fuck up the whole thing. We don't want to do that. So by the end of today, you'll see exactly how we create the first full loop. And then day 3, tomorrow, will be about scaling and making it evergreen. So, the power of collateral. Why is this so powerful? We invent liquidity from thin air. We invent new money. We just create capital just like the banks do. You get a loan, they just create money for your loan. They just create the numbers on the screen. To monetize our Bitcoin and other blue chip assets indirectly without ever needing to sell. You can borrow against it, instant usable cash. If you're out here and you need to flight somewhere, if you have a hospital bill, emergency, you don't have to sell your Bitcoin. You can just borrow money against it. There's lots of use cases for unlocking your liquidity without having to sell your Bitcoin, maybe even at a loss. Again, don't kill the golden goose. It's indirect monetization. You keep your raw price exposure to your Bitcoin, Ethereum, Solana, etc., while using its equity, pulling that equity out of the asset to actually fund the lifestyle, fund the expenses, emergencies, and use it to buy more assets. Permissionless access. There's not a credit check, no applications, there's no bank hours, no approval committees. The protocol offers transparent 24/7 permissionless. You don't need a reason, you don't have to get it confirmed with anybody. Whenever you want, as long as you have the Bitcoin, the collateral, you can do this at any time. And it's a compounding tool. When used correctly, debt is not a burden, it's leveraged. It's what allows you to multiply your capital and get exponential returns when the bull market comes back. I truly believe that this strategy is the best thing you can do for your portfolio, and it will accelerate just how much money you make over time. But first, of course, we need to understand good debt and bad debt. Good debt is used to acquire assets, income-producing positions, or anything that actually increases your long-term net worth. Borrow to invest in real estate. I think most of us are familiar with that. You borrow money from the bank, you get your first property, maybe it's a rental, maybe it's a home that you live in. Borrowing to acquire an income-building skill set. Maybe you're borrowing some money to go to school, etc., to get a better job, earn more money. Borrowing against crypto to earn yield or hedge. That's what we'll be doing here today. Bad debt. Consumer purchases and luxury items. If you're pulling out debt to get bags out here in Koh Samui, maybe massages. If you're pulling out debt for massages at a 10% APR, it's very, very not good. The higher the interest rate. If you're credit carding these massage girls, very, very bad debt. Not a good idea. Borrowing to fund lifestyle expenses. Good debt is used to make you more money, get into assets, get away from the dollar that depreciates over time. Bad debt is anything that's not going to make you money and going to hurt you in the long run. Don't be pulling out this debt. Don't be borrowing against your Bitcoin just to start buying a bunch of Gucci bags and all this and that. It's not worth it. So how do we evaluate our debt? First, interest rate. Is the cost of capital manageable long term? Low rates, manageable. High rates, dangerous. Credit cards, very dangerous, I'd say predatory APRs. In the DeFi space, most of the loans right now that I've seen, we're going around like 3, 4, maybe 5% max. So it's very, very safe, healthy interest rates, but you do need to manage these and watch them over time because they do fluctuate. Purpose. Is this helping you grow or is it draining you? Again, it's just a good or bad debt. Scenario. Cash flow. Does it create stability in my life or is it going to stress me out? Am I too close to my LTV where I'm going to get stressed out? Is it actually paying me to where I can then take the money and it adds freedom to my life? Or am I stuck on a tight payment schedule that's going to just stress me out where I'm stuck just trying to pay this loan back, And back to the repayment terms as well. In DeFi, there is no repayment schedule. So there's not a bill due. Your loan would just increase in value over time. If it's just going to grow at 3%, you pay it back whenever you need to or have to. You want to check your liquidation thresholds, which we'll go over here soon as well. And again, flexible duration in DeFi, there is no payment schedule. So if I just borrowed $50K, for example, I'm not having to make $2,000 or $3,000 payments a month or anything like that. There's no $100 payment a month. It literally just grows over time. It's very, very cool. A lot of people from the TradFi space don't realize that there's literally no payment schedule. So when you're borrowing against Bitcoin, you just wait for your Bitcoin to double maybe, and then you can just pay it off for free. Pretty interesting. Why DeFi lending and borrowing matters. You earn additional income. Again, this is just the core concept. We're lending our assets to earn. When you first lend your Bitcoin, you earn a little bit of interest usually as well. But the real superpower is we borrow against them 3, 4, let's say 5% a year, and we're using that to create cash flow and stack that yield. You're paying that 4 or 5% a year, and like we talked about yesterday, things looking at 6, 7, 8% a month. You're making all that interest back that you pay over a year in like the first 2 weeks. It's very, very exciting. You access liquidity again without selling, so if you need money, you can just borrow against your Bitcoin. Whether that's, again, an emergency, if you want to open a business, whatever that may be, it's literally up to you. You don't have to ask anyone about it. You just need to make sure you are being responsible with your debt. And very powerful, you maintain your price exposure. So when you believe in your Bitcoin long term, kind of like a lot of the rich do with their stocks, their stock positions, Elon Musk and Tesla, they're not selling their stock, they're just borrowing against it. They borrow against themselves and they just service that debt. And when you borrow, it is tax-free. You are just inventing new money. You're not selling your Bitcoin, then having to pay taxes, taxable events. You're just creating new money and you're paying that APR per year. Increased investment capital. It allows you to diversify, reinvest in other opportunities, and deploy capital where the opportunity may be stronger. So here's how it works. It's actually very easy. I promise you, it's the easiest thing we'll do here. You supply your asset. Go to a protocol like Aave. You're taking your Bitcoin, your Ethereum, and you literally just deposit it into the protocol. It's as simple as a one-click process. You usually start earning an interest rate immediately. It's usually very, very small, not very exciting. But then you can use it as your actual collateral. So your Bitcoin is in there as the property that you can borrow against, and you're maintaining 100% exposure and ownership to that Bitcoin. You get 100% of its appreciation and depreciation, but the power is where you can just borrow against that Bitcoin. Here's the nitty gritty. It's not just free money. You have to be safe. We've talked a lot about this, LTVs. What is LTV? It's your borrowed amount divided by the collateral value. If you had $10,000 of Bitcoin and you borrow $4,000 of USDC, basically cash against it, your loan to value ratio is 40%. You're borrowing 40% against your equity. You want to keep it healthy. I've always recommended for everyone 30 to 40% max. For most protocols, that'll put you in a position where your core asset can actually cut down by 50% and you'll still keep your loan safe. We've experienced that firsthand. Bitcoin, I do tell people that's the one asset I would let you, it'll let you borrow more, but I would let you borrow 50% at a very low point in the market, like right now, 50% on Bitcoin only. Other assets, 30 to 40%. The more volatile they are, like SUI on down the list, you really want to be closer to that 30% mark just because it can swing so hard. It's down like 80%. The danger zone. As your Bitcoin price drops, the LTV rises. So if this was $10,000 and it dropped to $8,000, we would now have a loan to value ratio of 50% because you have $4,000 borrowed against 8. And that's where you need to monitor the actual loan to value amount. That's what matters. Liquidation, usually about 75 to 80%. So if you're setting yourself up where you're borrowing about that 40% amount, it lets your asset get cut in half before you're hitting that 80%. Making sense so far? Kinda? Going through it too fast?
Yeah.
Kinda?
I'm still catching up on yesterday.
Yeah?
If you're close to that 70, can you base them off to bring it down?
That's the next slide, I think.
Next slide.
Yep. So when we're down here, again, in a very safe range, as we start to go over that 40%, you just need to be careful, especially depending on where we're at in the market. If you're at a 50, 60%, like it's already dangerous to begin with, but if you're at that point at a high in the market, Bitcoin all-time high, I wouldn't say it's out of the question for that asset to come back down to 60 like it did. Right now, I'm taking on more risk. I'm getting closer to those 50% LTVs because we are at such a high value zone in the market. But you do want to be doing this at the right time. You want to be taking out the leverage when the market's low, good opportunities, just like when you're buying normally, not when the market's high. When the market's high, we'll talk about that, I think, here in the next slide. If you have questions, you can stop me too. All right. It's 2 slides away, I think. We'll get there. So, 30K in Bitcoin. We've had people in the fast track ask before. I have $30,000 of Bitcoin. I think you had 17 we talked about. I want to farm yields, but I don't want to sell that Bitcoin. I don't want to pay the taxes on selling it. I don't want to give up my Bitcoin exposure. If he sells, he loses that upside exposure usually because you get cashed out at some point, maybe too early. A lot of people want to hold their Bitcoin forever until it's $1 million asset, 500K asset, etc. If he holds, the problem is he earns 0% yield. So he's making no money every day, still has to work his job, he's holding the Bitcoin. One day it'll be $1 million, but until that day, he's just stuck holding $30,000 of an asset and making no money. Don't sell the Bitcoin. Supply it as collateral, borrow against it. You take the $30,000 in Bitcoin, you send it to Aave, deposit it in there, and you can just create $15,000 of USDC to use in a farm or a pool that will make you money every single day. $30,000 of Bitcoin, $15,000 of debt on the blockchain, and the result is that he gets the appreciation. If Bitcoin goes from his $30,000 bag of Bitcoin to $60,000, he makes $30K in appreciation. His liquidity pool will generate daily cash flow as long as this takes. I can send you the slides too, if you want. Yeah, I'll send it to you. He's making money every single day, and his liquidity pools will appreciate in value as well. So he's going to have at least the 15K in the pools, appreciate, plus his 30K is going to go up. He's the 15K in debt. The point being is that he keeps his raw exposure. He's making the pools, the yield each and every day, and the pool's value will also increase as well. And you can choose to pay off the debt, wipe that debt clean, and you have made a lot more money. Did I make that confusing? I feel like I made that confusing a little bit. Maybe? Yeah?
I'll get there.
Yeah, we'll get there, I promise. The live example will make it easy. The double whammy. this is what I was talking about in the last slide. You combine 100% of the price exposure, so the volatility of your Bitcoin, combine it with daily cash flow. And so in the next graph, you'll see the blue line and the yellow line, but you are taking your core asset and you have the cash flow machine as well and the price appreciation. So again, if Bitcoin doubles, you get the doubling in value and you're also getting daily cash flow, and this exposure here will also increase in your actual capital amounts. You are growing there as well. It's like buying a house. You don't just hope the house price goes up. It's not just the appreciation. You're not just waiting for your house to appreciate. You're not gonna really get rich that way. You rent it out to tenants and you get paid every single month in cash flow. In DeFi, your Bitcoin is the house. The borrowed capital is the rental income engine. You need both. Income is what's gonna get you the freedom. Bitcoin will get you freedom long-term, store of value, it's gonna make you money, but the cash flow is what's actually gonna get you the freedom today. It's gonna let you get the lifestyle you want. It's gonna let you live where you want to live, work what you want to work, be who you want to be. And it will exponentially scale how much money you make. Your assets will be able to buy more assets. You get growth and income. And yesterday we talked a little about impermanent loss. Impermanent loss does not touch your core Bitcoin stack because you are never selling it. It is the collateral, so you're never getting cashed out into USDC. Like yesterday with the Ethereum example. Eventually you end up in cash. Remember, Alex, we talked about that? In this example, that core asset, it's never cashed out. It's raw exposure 100% of the time. Here's a little graph. If you're running pools, this is not showing yield as well. So let's say you're in pools, eventually you're getting cashed out into USDC. You know, this is not to scale, by the way, either. It's just lines to show you the difference. But if you're in LPs alone, you're getting smaller amounts of appreciation, but you also are getting yield. So the longer it takes price action to go up, actually the closer these two lines get, and sometimes the green can even exceed, especially if the price actually ends up moving down. If you're holding Bitcoin, you're just waiting for appreciation nonstop, just waiting, hoping. This is again assuming price goes up over time. If it goes down, it's just fucking straight down. You're just losing money. When you combine them together, you're getting your core assets price performance, plus the LP's price performance, plus cash flow each and every single day. The longer you're in range, the longer these pools are running, again, you're adding to your stack each and every month. If you're even just growing at 5% a month in cash flow, you're just getting an extra 5% of Bitcoin every month to add to the stack, waiting for that Bitcoin's price to appreciate. Good? You guys can stop me at any time if there's questions. I promise. So here's what me and Connor actually talked about a bit on the side yesterday. How to deploy your daily income stream. When the market's low like it is right now, it's very valuable. You can aggressively stack that Bitcoin. This will increase your LTV. Be buying more of that Solana. You're actually making it a healthier loan, buying more assets. It's much more valuable, I'd say, to be buying the actual assets themselves at this price than it is to pay down the loan. I'm looking at these prices to be increasing the loan value, be pulling out towards that 40, 50%, but use the cash flow to aggressively increase my reserves, increase that treasury. When the market's hot, Bitcoin's at 120,000, 125,000, you want to be stacking stablecoins on the side or paying down that debt because in my opinion, again, Bitcoin back at all-time highs, it's a better return. It's a safer play to be paying down the debt or stacking the stablecoins, lending somewhere where you're earning more than you're actually paying, than it is to be buying Bitcoin at too high of a price. When you're making money, these LPs, they're paying you every single day. You choose where to actually move those assets, like we were saying, Bitcoin, stable coins. It doesn't have to be just that. Some people want to use allocations to gold, things like that as well. Other assets, go down the spectrum, get Ethereum, Solana, Sui, etc. Build the altcoin bags. The more collateral you have, the higher borrowing power you have, more liquidity pools equals more income. So it starts to actually feed itself. As you make more money, you get to buy more assets. And as you get more assets, you get to borrow more money to make more money. And you can start to leverage the game. Get the flywheel started. Allocation strategies. It's kind of the same fucking slide, actually. High value zones, we're getting spot assets. Yeah, we just talked about this really. There's no one size fits all though, where you're putting it, actually the money, okay? So again, I was talking about assets when the market's high value, stable coins when it's not. You can be looking for gold, you can be looking for stable coins. You can start to systemize maybe that no matter what you make, 50% is always gonna go to Bitcoin. 25% is always gonna go to gold. So I have a little reserve that's not the dollar. And then 25% that's the dollar that I have just ready to go on chain right there. to deploy whenever the market does end up becoming a high value zone. These are sat on the side. This is to get away from the dollar still. This is to just have some dollar exposure ready to go. And when the market does come back, you have those reserves that you were stacking for maybe months at a time, 25% of your income, you just kept over there on the side. And when the market pulls back, throw it in. You have it ready to go. But in case it never pulls back, you're buying Bitcoin with 50% the whole time. Win for sure. And this starts to scale. As your collateral assets appreciate, your borrowing power expands. This is how you will fund new business lines without even needing to inject new capital. As your collateral grows, let's say your Bitcoin, it's up $5,000. Well, if we're borrowing at like a 50% ratio, that means that you have another $2,500 that you could pull out to put into a new liquidity pool and start making another couple $100 each and every month. Access 50% of the loan, deploy and scale, just talked about that, rinse and repeat. And so when your assets appreciate, again, it's more money you can borrow. And as you add more assets with the cash flow, that's more money you can borrow. Making sense? Yeah, Connor? Good? I need a drink. Anything, Jake, you want to say?
Well, this is something that I've never really looked at. I've always avoided this, right?
Mm-hmm.
But it's,
Does it make more sense to you yet?
it makes sense. And I'm generally thinking about, like, let's just say a live example for me. 1 Bitcoin is 60, whatever we're at today. You take that to run LP bills, maybe even back to the ones that are already working. Would you recommend that for me?
Say 1 Bitcoin directly into pools?
Oh, no.
Or 1 Bitcoin lend, borrow 30K?
Whatever you said.
100%.
To scale the same bills, or well, I don't mind to do them.
I've been trying to get you to.
I know, but I've never really sat down and looked at it like this. I'm just like, oh yeah, just put in free money. Do you know what I mean?
Yeah.
But right now, it makes a lot more sense.
We'll show it a little more too in the live example, but like in the long term, it just makes you so much more money.
It does make a lot of sense.
The infinite game. It's the juicy part. I'm kind of like beating this over the head. It really is like a very simple strategy. Once we just have to get the steps going, right? To where you're actually getting it going, but it's just the 4 key steps. Buy collateral, usually your first purchase. You're buying Bitcoin. Deposit it on Aave and then borrow tax-free debt against our equity. We're just creating money that we can use. Pay it 3% a year to then deploy and start earning yield at even, again, let's say worst case, you make it 5% a month, 6% a month, aiming for 10% a month. And you use the cash flow just to buy more assets. The market's hot, you can just go down to paying down debt instead. But again, we're just cash flowing more assets, which gives us more money we can borrow, which lets us deploy more money to make more cash flow, and it just fucking scales. And it scales over time. And it takes the stress out of the game. I don't need the market to do anything tomorrow. I don't care if we're at 60K or if we're at 70K or if we go back to 90K tomorrow. I'm in a win for sure position where if my collateral appreciates, I make a shit ton of money. If we go sideways, I'm making shit tons of money. If we go down, I'm still making money every single day. Rinse, repeat, scale the system. It is Aave time. So I'm gonna be able to show you guys live hands-on. This is also stuff we could do with like Bonzo, that we were talking about with HBAR as well. I'm just gonna show you how to supply the assets, borrow against, deploy, manage, compound. Deploy will be kind of what we talked about yesterday, but really to just put this all together and make it make sense. So, any questions before we get to that? Surely there's some.
Can you borrow on every single altcoin?
Not every single one. And the farther you go down the risk spectrum, I'd say it gets more challenging because you want to really monitor those LTVs. And with assets that can swing really hard, it like Bitcoin, I would just say is the lowest ball of all of them. So it's easier to put yourself in that, like I'm safe in a 50% drawdown, where it's like, you know, even HBAR, Sui, Solana, these coins going down harder than that. Solana from 240 down to like $80 right now.
If you get close to that 75, you just sell a little bit off to the good.
What is $8? What's $8?
80, 85. Yeah.
He was about to jump in.
So I thought I had that on here too. I didn't see it come up.
Why everything is why $8?
But so if you do get liquidated, right? Which actually I think I just wanted to show you guys live, which is fun.
I was gonna ask to go off of what Jake said. I don't know about paying. If it gets to like was it 75 to 80%, you can make a payment so it can get back to 60 or something, whatever.
But if the market's low, what I was telling Connor yesterday, right? It's like I can also improve that stat by just buying more Bitcoin instead. That makes sense?
Bitcoin in the Aave.
because that increases my loan to value ratio.
Oh,
So
you can put more Bitcoin or buy more. So you can do that. You can just
the game never stops.
What you're on the same like account, I guess.
So say I have like 10 grand, and I borrowed 5. The market, and so it's 50% LTV, right? It's like right at the most I really want to have it at, and the market moves down. It's like, well, it's such a high value zone for Bitcoin there. Say I have 8 grand with 5K borrowed. I need to do something, right? I need to make a decision. I'm going to look to just add more Bitcoin, so my loan gets healthier that way. I just add more collateral.
DTE.
If the market was hot, then that's when you could look at either, which, you know, for you to keep it simple, like paying down the debts. But for some of us that are a little more like in the game, it's like you could be lending somewhere. Like if I'm borrowing for 3% and I can go to Navi on Sui and make 8%, it's like, why would I pay that, you know? And, you know, at a larger numbers game, it makes more sense, but you're still making an extra 4% having the loan open. You wait for the market to pull back, you can deploy again.
Guys, hopefully you found immense value in this day 2 talk. This is seriously the strategy that will supercharge your portfolio, and it's the most valuable skill to know and learn in DeFi. Again, I'm taking it from the real estate game, the private equity game, and just applying it here in crypto to supercharge your returns and make yourself just even more money over the long term and play a game that never ends. It's the infinite game where the game will never end for you and you just keep making money every single day. And when the bull run comes back, you're making insane amounts of money. If we go sideways, you're making good amounts of money. If we go down, you're making money to offset your losses and DCAing into better assets at cheaper prices. Again, day 2, rewatch this if you need to, take more notes, learn and implement these strategies small. It is the best thing that you can do for your crypto and DeFi portfolio. If you want help, you can click the link down below. Book a free call with me and we'll get you started as soon as possible. Day 3 will be coming out soon as well. Day 3 will be a little more advanced strategy, shorting the market, going delta neutral, how to actually, where to put your profits to succeed long term. That'll be coming out soon. If you're watching this video a little later after it releases, it should be linked right up top. But again, guys, get started today. Open your first position today, lend a little Bitcoin, borrow against it, see how it works, throw that into one of your liquidity pools, just see the system work for you. See how you can scale it, see how you can turn that into a system that creates the life of your dreams. Book a free call with me down below, and I'll see you on the other side.
The fear you feel right now, it's not a warning sign, it's a signal. It's the market telling you that the opportunity is still here, it's still available, and it's still yours if you're willing to move while everyone else stands still. So the question is not, is now the right time? The question is, how long are you going to let fear make your decisions for you?